Hello friends, hope all of you and your families are safe during these times. In the next few minutes, I am going to take you through the key events of the recent past and Kotak Mutual Fund's view on equity markets. Markets in February witnessed significant volatility, almost all of it emanating from global developments. The first half of February was dominated with news on inflation globally at significantly elevated levels that various central banks have moved to target inflation from supporting growth. The second half of February was dominated by events in Russia and Ukraine, where war was declared and sanctions on Russia by various Western countries impacted commodity prices and sentiments. On the domestic front, corporate earnings for the quarter ended December 2021 were largely on expected lines. All of these developments in a backdrop where foreign institutional investors have continued their selling in Indian equities almost incessantly. Let us examine each of these factors in some detail. With inflation prints in many parts of the world, especially US, continuing to remain elevated, central banks across the world have moved from growth supportive policies to inflation fighting. Supply chain bottlenecks still remain high, especially as China continues to follow a zero COVID policy, leading to creep up in commodity prices. What started in semiconductor chips spread to basic commodities of metals, then to food and now to energy prices as oil and natural gas flared up significantly over the last few months. While many of these will normalize, for now, persistently elevated levels of inflation has meant a possibility of steep hikes in interest rates as well as withdrawal of central bank liquidity. With interest rates rising, growth stocks, especially in the tech space, saw significant selling across the world in the first 2 months of this year. With energy prices inching up due to the tightness in the market, it got further jolted when Russia announced a war on Ukraine. NATO allies embarked on announcing significant sanctions on Russia, with access to Russian central bank cut off from international markets. Russia and Ukraine account for a significant proportion of commodities, crude, steel, aluminium, palladium used in semiconductor chips, etc. With sanctions, there are now worries that these commodities could see further elevated levels till this conflict resolves. Post the conflict getting announced in the later half of February, crude oil has already crossed $100, adding further pressure to inflation levels, thus eroding the common man's purchasing power. Given these developments, across the board we have seen equities correct. After a dream run of 18 months from COVID lows, this is the first major bout of volatility. Given the global nature of these developments, FIIs have persisted with their selling. For the month of February, FIIs have sold close to 46,000 crores. Barring the month of September 2021, where they were net purchases by a small amount, FIIs have sold in all months since April 2021 in the secondary markets, with some of the selling being used for IPO in the primary market. On a 6-month basis, selling of such magnitude on absolute crores is almost similar to levels seen in the global financial crisis in 2008. As a percentage of market cap, FIIs have sold to levels from where generally FII selling intensity has reduced in the past. Regardless of such selling intensity, Indian markets have been large outperformers in the last 1 year thanks to improving fundamentals as well as absorption of this huge selling flows by Indian households. Domestic institutional investors bought close to 42,000 crores in the month of February alone, almost matching the selling intensity of FIIs. Lastly, results of corporate India for the quarter ending December 2021 have broadly been along expectations. Beats were seen in financial, IT, capital goods and auto sector, whereas there were misses in sectors like cement, consumer staples, home building, etc. While sales of listed India have improved quite dramatically, margins have come under pressure with elevated commodity prices. Given this, pace of earnings upgrade that one had witnessed in the last many quarters has now slowed down. However, corporate India is in much better shape, having reduced leverage during the last 2 to 3 years. Along with improving economic activity, this augurs well for corporates to plan for capacity augmentation. Valuations have also moderated a bit as markets have consolidated over the last 4-5 months. For sure, geopolitical risks have gone up, and while direct impact on Indian economy is limited, indirectly India will get impacted with high energy prices, especially if crude sustains at $100 for a long term. However, in our view, these risks are transient and unlikely to impact longer term competitiveness of Indian companies. If any, Indian companies can benefit in the long run with more outsourcing, especially as Ukraine and Eastern Europe is one of the faster growing supplier of IT talent, as well as value chain in the manufacturing sector wanting to move to stable countries like India. Given that ups and downs are part and parcel of asset classes like equities, it is only natural to expect higher volatility in the times ahead. However, rather than obsessing over fear of fall, we would encourage investors to use such opportunities to increase allocation to equities, especially if one is underweight this asset class, as is the case for majority of Indians. Given this, a disciplined asset allocation with a focus on longer term goals is imperative, and equities continue to be an important avenue to fulfill longer term goal obligations. Be patient investors, and do remember, time in the market is more important than timing the markets. Thank you and stay safe.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.